Today I wanted to talk a little bit about a blog I wrote on some bonds that we just recently tendered to an offer as an example of market inefficiency. So these were bonds of Shared International that we bought at 47 cents on the dollar back in the depression-like conditions for commodities in early 2016. We paid 47 cents on the dollar for the bonds. We had a running yield of 17% and a yield to maturity of 27%. And we took advantage of market inefficiency and kind of panic at the time to buy the bonds. And now we're taking advantage of what I think is a overly generous company buying back our bonds for 95 cents on the dollar. I'm generally happy to take 95 cents on the dollar for my distressed bonds. And further to that, at a point in time while we owned the bonds, they extended their maturity date, and in order to get the consent of the bondholders to do that, they offered an incentive, and that incentive was paid in either cash or warrants on common shares of the corporation. We chose the warrants, and so we have a continuing exposure to share its recovery and the recovery in nickel prices as a no-cost, zero-risk exposure after having tendered our bonds for 135% return. So there you go. The market's not always efficient, and there are opportunities within the marketplace to take advantage of these inefficiencies despite what you hear.